Welcome to the Allan Small Financial Show. Thank you for taking some time out of your busy day to spend it with us. We've been doing these shows now for a number of months. However, our mission has never changed. We're here to provide some guidance, some assistance, and to make some sense out of these crazy markets that we've been seeing, especially this year. If you have any questions regarding your portfolio, if you have any questions regarding the markets in general, please feel free to type it in through YouTube or Facebook Live, whichever avenue you're watching the show on today. I'd be happy to answer your questions at the end of the show. We also, from time to time, have some really great guests. We have a great guest today, so that'll be a lot of fun. We'll get to that in a few minutes. But overall, our mission, as I said, is to help you, the investor, understand what's going on in the investment world and really understand how best to navigate these volatile times. So without further ado, let's get on with the show. So on the show today, we have a great guest. Patty Levitt-Reid will be here, and can't wait to speak with her. It's been a little while since her and I have worked together, so that'll be a lot of fun. We also will have our usual This Week component to our show. We'll talk about what individual investors should be considering over the next couple of weeks before they make their investment decisions. We're going to talk a bit about short-term investing versus long-term investing. Why can two different investors look at this time in the markets, one as opportunity and one as perhaps I can't get involved in the market at this time? So the answer to that, time horizon. We're also going to talk a bit about how strong the US dollar has gotten versus all the major currencies around the world and versus our currency. We're noticing our currency now sitting somewhere around 73 cents, a lot lower than what we've seen over the past few years. And lastly, we're going to take your questions. What questions do you have for me today regarding your portfolio, or perhaps a general question regarding the stock markets? I'm here to answer as many questions as I can at the end of the show. So if you do have one, please, as I said earlier, enter it into the YouTube Live space or Facebook, and I'll be happy to answer them at the end of the show. So I'd like to welcome personal finance expert and author Patty Levitt-Reid to our show. Patty is known for giving tips on how people can save money and stretch their incomes. Many of you will recognize Patty from her days as former chief financial commentator for CTV News. She is currently chief financial commentator from Home Equity Bank. And in the past, she also served as senior vice president at TD Waterhouse Canada. And also, I have to add, worked with me many times on BNN. And on her own personal show a few years back, I had the privilege of working with her as well. So I'd like to welcome Patty Levitt-Reid to our show. Thanks for being here, Patty.
Allan, I'm absolutely delighted to be here. There is just so much going on, so much fear, concern. Go ahead. Let's just chat.
Let's just chat. Yeah. And so, I want to start off by talking a bit about the markets. Mm-hmm. Obviously, the markets have been down for most of the year. I think fear or investor fear is at pretty much all-time highs right now. A lot of people don't know how much further this market can go down. I get calls all the time, Allan, how much in the way of losses do we have to weather before we start to see things turn around? So I guess my first question to you is, what do you think is causing this market to fall as much as it is? Obviously, central banks
in progress
have a lot to do with what's going on, but do you think the response by central banks to what's happening, the inflation rate, is actually worse than the inflation rate itself? Is the cure worse than the disease? What do you think, Patty?
Wow, that's an interesting way to put it because, there's no question about it. Fear is getting near record highs. We've watched people pull out of the market at levels that we haven't seen in about 32 years. And so there is a certain element of anxiety. There's no question. I do think central bankers around the globe need to beat down inflation, and the sooner the better. The problem is it takes time. Has it peaked? I'm not certain. Will the Fed and even the Bank of Canada go too far? Maybe. But at the end of the day, I do think, Allan, we can only control what we can control. I can't control the markets being volatile. I can't control that interest rates are headed higher. September, living up to its reputation in the market, no question. But what I can control is how I respond. And so I can tell you, and I'm very comfortable telling you, we have not sold out of our positions in our portfolio. We maintain steady as she goes. I do and believe I can control my asset allocation. And that, of course, leads into diversification. And, in many cases, we're being paid to wait, where really good quality companies, leaders in their industry that have been consistently paying that dividend, well, they're blunting the blow to some extent. So are people anxious about it? Absolutely. Are they living close to the margin? They are. But I also think, Allan, and I'll throw it out there to you, is that there is this fear, even in the background with all of this, that the economy is headed towards a recession. It'll depend. The odds start to increase as rates go higher. People stop spending. Corporations aren't making what they once were. And you put it all together, it's a very uncomfortable and sort of scary period.
Yeah, I agree. And, we heard Federal Reserve Chair Jerome Powell say recently that the biggest thing he's hearing from the people he's talking to is that higher inflation is eating into paychecks, into people's incomes. But I guess the question I would ask if I had access to him was, it seems as though they're choosing the lesser of two evils, right? So they've said that they need to see or are willing to see unemployment rise before they can get inflation under control. So I made the kind of cute comment saying, yes, it's eating into people's wages, but if you're going to raise on the unemployment rate because you're raising interest rates and people are going to lose their jobs, then what is it going to eat into? Perhaps people's credit cards. So
we're seeing that.
Yeah, exactly. It's a difficult balancing act. I guess they're choosing the lesser of two evils. They're trying to bring down inflation by slowing down demand or clamping down on demand. And I'm not so sure that is the right answer. At least raising rates makes sense, but at the pace they're doing it, one of the fastest paces we've ever seen, going back to the Volcker days. So I'm not so sure that the pace of increase at least should not be slowing down at this point in time, and perhaps taking a pause to wait and see what effect this is actually having on people in general.
Well, I think that you're not alone in that thought. We heard from one of the Fed officials in the US, it wasn't Jerome Powell yesterday, that made reference to the fact that the Fed may overshoot, may go too far, too fast. And then the markets had a hard rally, reversing course from the previous day. Then they start to sort of, pull back yet again. It's one of those things when it comes to inflation, people, yes, they are saying that it is eating into their paycheck. I also think sometimes inflation can become a self-fulfilling prophecy. And so what I mean by that is more and more people are saying, okay, I'm going to go out and get a secondary income so that I can continue the lifestyle that I have, or I'm going to compromise. And if rates continue to go higher, what this means is I won't be traveling. And then the knock-on effect, the volatility in the market, and this is just something that I think happens, is that you get to a breaking point. And I talk to the average Canadian on the street. So my fitness instructor, I was working out with her, and she said, I sent back a designer pair of leggings because all of a sudden I thought to myself, the extra $20 that they're now charging for that isn't worth it to me. So she is sending a very clear message to the company that, and it's one person, but if one person does it and another does it and another does it, eventually, yes, corporate profits are going to be eaten into because they're not going to be able to pass this along to the end user. So you've got on the one hand where people can say, I am going to be part of this inflation cycle. I have a rental property, and like everybody else, I'm going to continue to raise the rent. And they'll get to a point where that renter says, I can't do it anymore. I can't pay that anymore. And then things start to tip over. So I guess my point is, it depends on whether or not you decide to get through this period of time by pulling back on your spending and being razor sharp on your numbers. Know that we've gone through periods of inflation before, and we will get through this period as well. It's been around longer. It has certainly not been transitory. And that's what's frustrating. And so I think this is a little uncharted for the Fed. And I agree with you. Two things are going to happen. Either you're not spending because things are too expensive. You're not spending because you don't have a job. And so any way you look at it, the outcome is the same. And that's the economy continues to slow.
Yeah. And how do you find, I guess, your conversations with small business? I know I've talked to a few. They're seeing their costs rising now every which way you can imagine. Either it's raw materials, or they're seeing, salaries going up. Obviously, they're having a problem with labor. They can't find enough people to work a lot of places. Now, all of a sudden, the debt that they've taken on to grow their business is now costing them a lot more over the past 9 months. What are you hearing from small business? I know I'm hearing a lot of negativity, unfortunately.
Yeah, it's a very negative environment. It is a very tough environment for small business owners. There's absolutely no question about it. I'm hearing the same thing. And I wonder, when you look at our immigration here in Canada, I will talk to young workers, I can say that, very young workers. And what they will tell me is that, yes, they want to work, and yes, they can find jobs, but there are just not enough of them out there to fill all the job vacancies. And last I looked, I think we've got like 1 million job vacancies here in Canada, but we don't have enough people to fill them. So it's not that people don't want to work, but on the other end of the spectrum, you've got those in a certain demographic that are saying, I've kind of had enough, and I can afford this. But we can't sustain that here in Canada. Like, it's just not. And then you've got those who simply say, if I, for example, I work in this particular diner and I'm, being paid X amount. If you're not prepared to pay me more because the small business owner can't, then they're going to go across the street, because the other guy has been looking for people for quite some time, and they will pay a little more if they need to so that they can stay operational. But it seems to me, I get this feeling that it is a vicious circle without being able to say, okay, here are the 5 steps that you can do to get out of this. And small business owners are struggling.
Yeah.
And you know what? I'm part of the problem. And I'll say that, Allan, because here's me saying, okay, stop spending. Don't spend. Build up that emergency fund. You'll get through this by having, cash is king right now. There's no question. But on the other hand, that same person who is saying, okay, I know the difference between a need and a want. I'm not going to go out there and buy that because I might want it, but I don't need it right now. And the knock-on effect is the small business owner that needs those who can afford to spend.
Yeah, for sure. They get hurt. So let's, I guess, try and end on a good note.
Okay.
And I know we've been a bit negative. So let's try and put on, I know I get asked this a lot, going forward, what do I see? Is it possible we could get out of this, time and move into better times for the markets?
And we will.
And we will, absolutely. So I guess my last question to you is, what do you foresee heading into 2023? I know I've said already, I've gone on record saying that I think the fourth quarter actually could see a bit of a turnaround into next year as the Fed and Bank of Canada start to slow down the interest rate hikes. I think things can start to get better. What do you think heading into next year?
Yeah, I'm thinking by the end of the second half of the year, we will start to see real progress, and we'll start to see things slow down. It may not and probably will not be where we would like it to be. But I do think, you start to look at some of the metrics, and they're moving so slowly in such a small way. But maybe things have peaked. And when things start to peak, they start to go down. And you know what I'm going to still watch for? Capitulation. That's when that last retail investor throws in the towel, because guess what? You guys, the institutional guys, will be in there picking them up. And that's what I don't want people to do. If you've got good companies, hang on to them. We will get through this. This is not our first economic downturn.
Absolutely. And we've been saying that. I've been saying that to investors now for a little while. Be patient. Difference between long-term and short-term. Got to know
Right.
how you're investing. And again, I want to thank you.
Emotions.
Emotions, for
Get
sure.
your emotions out of it.
Absolutely. I want to thank you for coming on today.
Thank
I
you.
really appreciate it. It's great to see you. And I'm sure we'll see you a lot more. I know you were telling me earlier, you're quite busy. So everyone will see you in many different places. And good
Thanks.
luck with everything. And I look forward to having you on the show perhaps down the road.
I sure hope you will. Thanks, Allan.
All right. Have a great day.
You
Bye-bye.
too. Bye.
So this is the part of the show where I talk about what I believe is important for individual investors to consider before they make their decisions or investment decisions over the next couple of weeks. We're going to touch on economic data. And I guess that would be in relation to the Fed. What does the Federal Reserve think about economic data that has already been released and to come? We're going to talk a bit about corporate speak or corporate announcements. What are corporations saying? What are CEOs saying about their companies? And lastly, government bond rates. Government bond rates, especially in the US Treasury rates, have become so important to how this market is moving up or down. You want to know how the market's doing on any given day? Take a look at a 2-year government of US bond, and that'll pretty much tell you what's going on. So those are the 3 things that I think you should consider over the next 5 to 10 business days. So let's delve into it a little bit more. Economic data. We're going to get a lot of economic data over the next couple of weeks. We're going to receive information on inflation. That seems to be the big one, obviously. CPI, PPI, PCE, all these different measures that we all look at to see how inflation is going, especially in the US, but also here in Canada. We know, and I've said this many times, that the economic data in the US seems to matter a lot more than our economic data, unfortunately. Our data seems to move the Canadian dollar, but not really our stock market. Also keep in mind that what is bad is good for the markets, and what is good, unfortunately, is bad. And I've said that a lot of the time, and that seems to be continuing. We continue to see resilient economic data out of the US. We just received some Michigan confidence numbers this week. They were one of the lowest numbers we've ever seen. Good for the market because it was bad data. But then we saw some other confidence numbers and some housing data that were relatively good. So the market then dropped shortly thereafter. So economic data and what the Fed interprets or says about this economic data, especially jobs data that will come out, I guess, shortly for September. We'll find out what happened with jobs for the month of September. That's going to be crucial in how the Fed reacts, whether they raise rates, continue to raise rates aggressively or not. And again, that will affect the stock market. So corporate data or economic data and the Fed are utmost important. The second point that I want individual investors to consider before they make their investment decisions is what corporations are saying. What are CEOs saying? I saw an interesting interview this past, I think it was about a week and a half ago, maybe a little less. I think CEOs were being interviewed. I think on CNBC, they were talking a bit about how they see their business as growing. Skyworks Solutions was one of the names in the semiconductor space. They make chips, as well as Marvell. They make chips. They were talking a bit about how they see a huge growth potential in their business, and they're still growing quite well. And you can see here, Skyworks Solutions, how much the stock has fallen over the past, let's call it few years. And you can see it's, once was a lot higher, over $150 a share, now trading well below 100. Marvell, same thing. It was up in the 80, 90 range, and now it's trading in the $40 range, so cut in half. And these are companies that I think, are at the forefront of innovation. They're the tech names. They provide the chips for everything out there. AMD, another name that has come out and continue to have good corporate earnings. Yet their stock has been cut in half, more than cut in half, down from about $160 a share. Their stock price is in the high 60s today. On the flip side, you're hearing other corporations talk a bit about how things are slowing, how they have to lay off workers or at least freeze hiring. We're hearing a number of corporations speak a bit about that. Companies in the cryptocurrency have laid off a lot of individuals. We're hearing companies like Google and Microsoft, and even today we're hearing about Apple, how their iPhone 14, they're slowing down production because demand seems to be waning. So overall, I think it's very important to understand what these corporations are saying and factor that into your investment decisions going forward. The third and final point I wanted to make with regards to what individual investors should be focused on to find out the direction of the stock market, it's one that people might find a little confusing and not so sure about. And this is the bond market. You know, we don't speak often about the bond market here on our show. We talk about having a diversified portfolio and owning bonds, government bonds like on your screen there, or corporate bonds. But right now, I'm referring to more government bonds, US government bonds, the 2-year rate, the 5-year rate, the 10-year rate. These are bond rates that have just shot up. The 10-year government bond right now is just touched 4%, has gone down below that today, which is why possibly the stock market is rallying quite strongly today. But if you were to look at the 2-year coming into 2022 is just above zero. I think it was like a quarter point or 0.3% in the US, and it's gone well over 4% now. And this is on the back of the Federal Reserve continuously raising rates and aggressively raising rates. As we know, the market doesn't like when rates go higher. So every time we see the 2-year or the 10-year start to spike higher, that is a signal or a negative signal for the stock market. So when you wake up in the morning, you want to know how the market's going to fare today, have a look at what US government bond rates are doing. That will give you a pretty good indication if today is going to be a struggle or a good day in the markets. Do you ever wonder how you could have two separate investors take a look at, for example, the stock market and its performance, and one investor will say, great time to buy, and the other one would say, can't touch it, I'm going to remain on the sidelines, I'm not putting any money to work. And I get this question asked to me all the time because people see individuals like myself going on BNN, going on Reuters, and they having commentary on Reuters or Canadian Press or wherever we appear, and you get one view, and then maybe a day later you get a totally different view. Well, one of the reasons for that, I think, can be summed up as time horizon. And I think it's important for individual investors to understand their time horizon. You see, a short-term investor today, they may need all their money to buy a home or to make some sort of purchase, to use that money. A short-term investor will definitely be nervous about investing their hard-earned money at this time because obviously they don't have a lot of time to make back any losses that they may have. Yet if you're an investor that has a longer-term time horizon, and I don't mean 10 years, 15 years, I know that's what the industry is going to call long-term, but everybody knows, if you see your portfolio drop for more than 3 months, you're probably going to give your advisor a call, give me a call and say, what's going on in this market? So long-term, even though we all say, 10, 15 years down the road, it's not really that long. But let's take long-term today. And what I'm saying now is the next 24 months, 36 months, next 1 to 3 years. If you have that type of time horizon before you're going to need all your money, then I think today could be a very good opportunity. When we look back at this market 3 years from now, what are the charts going to tell us? Is this going to just be a small blip on the way to bigger and better things? I think so. We have seen many corrections in the past, 2008, 2020 with COVID. 2018, we saw the Fed raise interest rates into a slowing market, very similar to what we're seeing today. And we've seen the market bounce back each time. 2019 was a strong year coming out of 2018. 2009, we hit lows in March, and then the rest of the year was fantastic. 2021, coming out of COVID, and 2020 was an unbelievable year. So I think you have to realize what your time horizon is. And for all of you that are watching the show and perhaps getting close to retirement or maybe in retirement, and you're going to tell me, well, I'm approaching retirement, Allan, I don't have a lot of time to be in this market. I don't have a lot of time to make back losses. I don't agree with that. Understand that as you enter into retirement, as you start to pull money from your investments, you don't pull it all at once. You may pull 5%, maybe even 10% if you're really aggressive, but the rest of your money will remain invested for years to come. And unfortunately or fortunately, everyone that is an investor today will probably be an investor until the day they're no longer with us in some capacity. Very rarely do I see anybody pull all their money out for something in retirement. It's usually, someone trying to buy a home or a big ticket item of that sort where they tend to use up a lot of their money. So understanding your time horizon is really important before you start to think about how to build a portfolio today. And remember, if you're going to be in this market, 2, 3 or years from now or more, I think this is a great time to invest. We're seeing many good quality investment ideas on sale for over 30%, some of them over 40% on sale. How can you pass up an opportunity like this? They don't come often. And especially if you're a longer term investor, I think you need to take advantage of these times, because as I said, they are opportunities that don't come along too often. So US dollar strength is the topic of this segment. The US dollar has gained so much strength versus all the other major currencies that we've seen two very important countries, the UK, Japan, actually have to go into the markets and buy up their currency to stabilize it. The UK just did that today. Japanese yen, Japan did this, I think, about a week or so ago. We're seeing the US dollar demolish really all the other major currencies except for ours. Even though we've seen our currency fall to below 73 cents, and as I talk to you right now, we're just above 73 cents, our dollar is actually hung in the best. And you can see here on the chart, when you look at our dollar as compared to the yen and the pound, the euro, and then obviously at the bottom, the US dollar, and you could see that against the US dollar, it's fallen by a little bit, let's say, not as much as other currencies have. Now, what does this do for business, the economy? Well, mixed. There are mixed, I guess, emotions, or what happens when you have a strong dollar and how it affects the economy is different for different people and different businesses. Some would say, if you're a manufacturer here in our country, or if you're a business that sells a lot of things to the United States, well, a strong US dollar allows companies or even government in the US to buy more of what we have to sell to them, because now our dollar is so cheap, they can buy more products and even services from us. And as we know, we export about 70 to 80% of what we create, pull out of the ground, to the United States. So for them having a stronger dollar, for our exporters, it's a good thing. But then you look at travel, for example. How many of us like to travel to the US? I'm one of them. Going down to Florida, although I don't know if you want to go to Florida today with a hurricane bearing down on Florida. But at some point, when you want to go down to Florida, that dollar becomes a big hurt, I guess, when you go and you start to convert your Canadian dollars. When you take that trip across the border to Buffalo and do a little shopping, that also plays a factor. When you look at emerging markets And a lot of the emerging markets are in the commodity space. Commodities are priced in US dollars. That becomes more difficult for a lot of these emerging markets. And multinationals in the US, when they do business, let's say in other countries, such as Japan, such as in Europe or in Asia in general, and then they bring those profits back to the United States. And when they go to report their results at the end of the quarter, obviously the currency and the difference in currency plays a huge factor. It eats away at a lot of these corporations' returns. And we've heard a number of corporations, such as Microsoft, for example, talk a lot about how a strong dollar is definitely affecting profitability. So going forward, should you, as an investor, take your Canadian dollars and invest abroad? I'm going to say yes. Even though we're sitting on a 73-cent dollar, I like to say that there's enough profit by investing in some of these good quality investment ideas that even if you were to lose 5, 6, 7% due to currency, I think these investments are on sale by 30, 40%, that the currency exchange, yes, it'll eat away a little bit, but nowhere nearly enough to make a big difference. And I think you must invest outside of Canada. I don't think it's, well, maybe, possibly. No, I think you must. Canada only represents 3% of the world's wealth. The United States, as an example, represents about 20% of the world's wealth. There are sectors in the US that we don't have much up here of, such as pharmaceuticals, such as big tech. These are named retail. Go to any mall in Toronto or in Ontario, Canada. How many of the stores in the mall are actually US-based stores? So even retail names that we have down in the US are a lot larger, and some of the bigger names you'll be able to invest in. I think there's some really good ideas down there, like a Target or a Costco. So I think you need to invest outside of Canada, even though the currency will work against you. But I think going forward, I hope to see the US dollar start to weaken a little and we start to migrate towards 75 cents once again. So this is the part of the show where I try to take a few of your questions. I know we're going a bit over time, so I'm going to be really quick, maybe take one or two only. If any of you have any questions, please feel free to send them to me. I'd be happy to answer after the show. I could send you a message back with my answers, or even, have those questions addressed on our next show. We had Patty Levitt-Reid earlier, and speaking to Patty is great, and I thought that was perhaps more important to have some more time there than make up a little bit with the questions perhaps next week. So here we go. I have a few questions here to address. I am retired. Can you recommend what percentages my portfolio should be divided into equities, into bonds? I guess what the question is asking is there a set percentage? How old I am should be represented into bonds, for example. So if you're 75 years old, should you have 75% in low risk bonds? If I'm 50 years of age, should I have 50% of my investments in low risk bonds? My answer to that is the rule of thumb, but I have clients that are in their 80s that are in full equity or stock portfolios. I have clients in their 30s that have a lot of fixed income. I'm going to answer this question to say it just depends on your investment goals, your objectives, what you're comfortable with. That should dictate what type of investments you're in, and what your expectations are should also dictate the type of portfolio we build. I'll take one more question. Last week, the US raised interest rates another 75 basis points and planning to continue. Does this mean Canada will follow suit on their next announcement? When will that be? So Canada will raise rates, it looks like, again in October. I think, I'm not so sure they're just going to follow blindly what the US does. They've already indicated that rates need to continue to rise, and it's more based on bringing down the inflation rate, which now sits at around 7%, more so than anything else. So I do expect Bank of Canada and the US to raise rates in November, Bank of Canada in October, and it'll be based on economic data, hopefully. And I'm hopeful that we're going to start to see economic data show us that inflation is starting to slow down, and therefore central banks will be able to slow down their rate hikes as well, which will cause this market to move higher. I want to thank everybody for joining the show today. I hope everyone got something out of the show, even if it's just one thing that you could take away and apply to your investments. I look forward to seeing you all at our next show in 2 weeks. We're going to have a great guest. Dan Kelly is on, head of CFIB, Canadian Federation of Independent Business. Should be a fantastic show. I look forward to seeing Dan and all of you in 2 weeks.